How Malaysia quietly built a $600 billion Islamic finance empire, the crisis Kuala Lumpur, 1997. Currencies are collapsing across Asia. Banks are failing. Foreign capital is fleeing. Malaysia should have broken. Instead, it did something radical. It turned inward. It rejected the IMF playbook. And it doubled down on an idea most of the world still didn't understand: Islamic finance. At the time, it looked like ideology. In reality, it was strategy. Context. Why this moment matters. Islamic finance didn't start in Malaysia. The principles were centuries old, but no modern nation had ever turned them into a full financial system. Most Muslim countries treated Islamic banking as a side product, a niche, a religious add-on. Malaysia chose something else. It asked a dangerous question. What if Islamic finance wasn't symbolic, but scalable? That question would reshape global finance. The key figure was Mahathir Mohamad, a nationalist, a pragmatist, suspicious of Western financial dominance. He didn't want Malaysia dependent on volatile foreign capital. He wanted a system rooted in domestic savings, long-term investment, and risk-sharing. Islamic finance wasn't chosen because it was Islamic. It was chosen because it behaved differently under stress. Malaysia didn't start with banks. It started with rules. In the 1980s, it passed laws that gave Islamic finance equal legal status with conventional finance. No ambiguity. No religious gray zones. Then came institutions. Bank Islam in 1983. Takaful, Islamic insurance, soon after. But the real breakthrough was the capital market. Malaysia standardized Sukuk, Islamic bonds, not as charity instruments, but as serious tools for governments and corporations. Clear contracts, clear risk sharing, clear returns. By the 2000s, Malaysia had done something no one else had. It built an end-to-end Islamic financial ecosystem. Banks, insurance, capital markets, regulation, all working together. The hidden mechanism, the uncomfortable truth. Here's the part rarely discussed. Islamic finance in Malaysia succeeded not because of religion, but because of discipline. Sharia rules forced transparency. They limited leverage. They discouraged speculation disconnected from real assets. In plain terms, money had to be tied to something real: factories, infrastructure, trade. During global crises, this mattered. When derivatives collapsed elsewhere, Malaysia's system absorbed shocks more slowly and more predictably. Islamic finance wasn't risk-free, but it was structurally cautious. That caution compounded. The legend says Islamic finance is slow, rigid, and ideological. The reality is more pragmatic. Malaysia engineered flexibility, religious boundaries, multiple Sharia interpretations, but centralized oversight, innovation without fragmentation. While others argued theology, Malaysia focused on execution. Today, over 60% of the world's Sukuk are issued there. Its Islamic finance assets exceed $600 billion. And global institutions, from London to Hong Kong, study its model, not its beliefs, its architecture. The big picture: civilizational implications. Malaysia proves something profound, that an alternative financial system doesn't need to overthrow global finance. It can coexist, compete, and quietly win market share. Islamic finance is no longer a Muslim world concept. It's used by non-Muslim investors seeking stability, by governments funding infrastructure, by corporations managing long-term risk. Malaysia didn't build a religious empire. It built a parallel financial logic. The question that remains: as debt-driven systems strain under volatility, as trust in financial institutions weakens, the question isn't whether Islamic finance will grow, it's this: will the future of global finance borrow more from Malaysia's restraint, or continue betting on speed, leverage, and fragility? That answer is still unfolding.